Hello, one rental at a time community. My name is Ty Leon Guerrero. I simply go by TYLG, or you can simply call me Ty. This is your Friday financial news wrap up for November 10th, 2023. Happy Veterans Day. Thank you all the veterans, the men and women who serve and keep our country free. Thank you so much. Happy Veterans Day. Let's get right into it. We're going to talk about the Fed, what their thoughts are on federal rate cuts. We're also going to talk about how does it relate to the 30-year mortgage. We're also going to talk about record high debts. A lot of talk about a debt bubble. Again, crash bros, doomers. Is it real? There's definitely record high debt out there. We're going to talk more about that. We're also going to talk about the SLOOS Report. What is it? It's basically where bankers give us an indication what's going on with lending overall as a whole industry. Also, the recession. Are we in a recession? Is there a recession coming? We're going to talk about all that and more and what it means to the one rental at a time investor, realtor, community member. So a lot of Fed talk this week. What's going on, Fed talk? Well, let's talk about it. A lot of the Wall Street, a lot of the talking heads, CNBC, Wall Street Journal, a lot of people are expecting the Fed to cut rates. Some people by as much as 4 rate cuts in the year 2024 next year. This week, Chicago Fed President Austin Goolsbee went on record to say that basically what the Fed is doing is working and that over the next several months, we can expect and probably see one of the largest drops in inflation that we've seen in the last century. So what the Fed has done is clearly working. Will we see rapid rate cuts? Time will tell. We're not through the woods. I believe with Michael Zuber has been really clear. He said this all year, higher for longer. We could see these rates stay sticky at the current levels. Although Michael Zuber this week also in the Daily Financial News went on record to say that he believes by February of 2024, that's basically, let's call it about 100 days from now, he anticipates that we will see the 30-year mortgage drop down below 7%, maybe as low as 6.5%, 6.75%, but somewhere in that range of 6.99%, and we should see an increased demand for the spring season. Now, it is good news. We're probably at the bottom in terms of transactions, but again, probably not enough to stimulate and bring a lot of inventory. We're still probably going to see inventory at record lows. We're also probably going to see transaction counts at record lows. Let's continue and let's get into it a little bit more. Probably the biggest benefit we would see, the biggest news headline this week was 30-year mortgage rates dropping from just above 8% to dropping somewhere in the below 7.5%. And that was really significant. A lot of headlines about it. Let's talk about it. What really happened? Well, a couple things is that they have what's called, and Michael's talked about this for a long time, terminal rate. And so what's happened is because the Fed has now begun to pause, meaning they're not hiking rates. And now even in fact, a lot of people, not the Fed, but a lot of experts are saying, okay, now next year, we're going to start to see rate cuts. Technically right now we're in what's called a pause, meaning that Michael's talked about this, the terminal rate. Now, how that relates to the 30-year mortgage. And I want to show you that this is a chart of the 10-year treasury. Now that the Fed has paused, now we can expect some stability in the mortgage-backed securities market. So 30-year mortgages typically trend off of the 10-year treasury. Okay, so right now, as an example, today it's at 4.6 plus. And typically, for the last year and a half, because of the Fed raising rates, we've seen mortgage originators, mortgage-backed securities, they've typically had about 300 basis points. Let's call that 3%, what they would call a margin. Now, in that margin, what they're doing is they're safeguarding because nobody really knows where our mortgage rate's going to go. Well, traditionally, mortgage-backed securities, mortgage originations typically trend at about 1.7 to 1.8%. I'll call that 170 basis points, 180 basis points. So now what we're starting to see in the mortgage-backed securities in the 30-year mortgage is now that we've hit a stable point with the Fed, we are starting to see stability in the mortgage-backed securities market and what we believe will be margin compression. And that from 300 basis points, we'll start to see mortgage originations begin to compress. And in fact, this week we saw a significant change. We saw a change of basically from about 300 basis points to 284 basis points. And so we believe, Michael Zuber has talked about this, I learned this all from Michael, that we'll start to see margin compression. Mortgage companies will begin to compress their margins, and that the normal mortgage origination market is typically about 180 basis points, 170 basis points above the 10-year treasury. Another hot topic this week, a lot of headlines, a lot of talk about record high debt. Will this be the thing that crashes the real estate market? Will this be the thing that bursts the real estate bubble? Let's unpack it. Let's talk about it. Now, Michael Zuber had a guest on this week. You can go back and watch the interview. I thought it was very interesting. A person by the name of Melody Wright. And Melody Wright is a mortgage servicing expert. She's worked a long time in the industry, working for servicers. She knows a lot about the forbearance, workout departments, loss mitigation. She has a tremendous track record and experience, worked very actively during the 2007, 2008 Great Recession, the mortgage meltdown. She is an expert when it comes to this space. Although Michael had a difference of opinion, and I also would agree with Michael, also being someone that worked through 2008, the Great Recession, the mortgage meltdown. I worked for Fannie Mae, Freddie Mac, doing a lot of REO, pre-foreclosures, also did a lot of short sales as well. I would also disagree with Melody for a couple of reasons, and I'll unpack that here. So Melody Wright's argument is basically because we've seen a rapid increase in 30-day and 90-day delinquencies in mortgages, that this is going to lead to a tsunami, tidal wave, or at least a significant market crash because of foreclosure activity. Now, I would disagree, and I would strongly disagree, only that, again, the last data I looked at, I published something on Instagram not too long ago, a few weeks ago, where I talked about Adam Data, Black Knight. They're probably the most well-known publishers of data on foreclosure activity. They basically talked about pre-foreclosure activity. Now, if you were to go from like, say, 90, 100,000 to 185,000 plus filing, and that is significant, right? So even if you said, okay, 2 years ago, we were at 30,000 plus or minus to now 120, 130,000. Yes, that's a 200 or 300% increase. I would agree. But the challenge is this. The MBA, not the basketball league, the Mortgage Bankers Association put out a stat this week that we're at about 3.37% of delinquencies nationwide, the whole entire mortgage market, and that's the lowest number. It's rising, but it's the lowest number since 1979. Okay, that's significant. And then also I want to show you a chart here that, again, if we try to compare, a lot of people like to say, okay, 2008, 2 or 300% increase in defaults, but it's just not the case. And let me show you why. Again, I lived through this market, so I can tell you firsthand, you know, for several years from 2007, 2008, 2009, we had significant filings, averaging close to about 1.5 million plus filings per year during that mortgage meltdown. Then, of course, over 900,000, close to 1 million plus repossessions, actually foreclosures, people losing their home. So folks, that is not the market we're in. 2008 is not going to repeat itself. We will see a significant increase, especially with a recession looming, which is what I'm going to talk about next. We will see an uptick in foreclosures. We could see a 200 or 300% increase in foreclosure activities, defaults, unemployment, and so forth. We're going to see some significant bumps in the road come 2024, but it's not going to be a tsunami of foreclosures. Let's move forward as we talk about recession. Let's talk about another report Michael talked about this week called the SLOOS Report. Now, what does SLOOS mean? It's the Senior Loan Officer Opinion Survey. And basically, this is on all things banking, all things lending. And it's basically like, what is the state of lending right now? What's going on in banking and lending as a complete industry? And ultimately, the report came back, and that the opinion survey came back that lending is tightening. There's a lot less loans that are being originated. And that's everything from commercial lines, from home equity lines, of course, mortgage we talk about all the time. It's significantly slower. But then even too, are we going to see a tremendous tidal wave of commercial defaults, foreclosures. That's all. We're starting to hear about it a little bit now. How will that impact the economy as a whole? Time will tell. Now, let's talk about a recession. This is interesting in talking about a recession. The one and only great Paul Tudor Jones, very well known for being one of the great money managers on Wall Street, private equity. He's a hedge fund guy. He's a philanthropist. I know of him because Tony Robbins refers to him incredibly well. I know he's friends with Tony Robbins, has been coached and consulted with by Tony Robbins. What's interesting is he talked about that in Q1 of 2024, we will officially be in a recession and that the economy is already showing signs of recession. Also, unemployment numbers. Michael Zuber talked about again in the Daily Financial News that we had seen a significant bump up in an unemployment, which again is the beginning signs of a recession coming and then what we will see in terms of a slowdown. So something to keep an eye on, folks. What does all of this mean? Let me unpack it. Well, the bottom line is for the One Rental at a Time community, folks, this is an opportunity. A couple of things I will encourage you. Michael says it all the time. It's the mantra of the show. It has been for several years now. Do the work. Meaning, when you do the work and you study your markets, you know the difference between a good deal, an average deal, a mediocre deal versus a great deal, folks. And in today's market, as we go forward into a shifting time, potentially a recession, in a weird housing market, guess what? If you're doing the work, you know we only are going to do great deals as a one rental at a time investor. Also for the realtors, for the real estate investors, wholesalers, fix and flippers, same mantra. We need to be doing great deals, not good deals. We need to be doing awesome deals. That even if things go wrong, even if we do see weird hiccups in the market, bad negative news coming forward in the next 30, 60, 90 days, you can still make good numbers on bad numbers. You can still make good money on bad numbers, meaning that even if all hell breaks loose, you've bought the deal well enough that it's a great deal, that you'll still be able to get out, get your original capital out, as well as make a small margin. That's the kind of deals we want to look for. Also for realtors, there's a lot of people that are going to need help. Pre-foreclosures are on the uptick. Now, are we going to see a tsunami of REOs? No. I just got 15 assets to evaluate for one of my old asset managers. I was a little surprised. That just happened in the last 36 hours. In fact, when I finish this recording, I've got to run out and go look at properties to evaluate. So we are going to see an uptick, but believe me, when I say this, I just don't see it's not going to be 2008. Okay. It might be a lot more like 1995, 94. That was a recession. We did see an uptick in foreclosures. There was a lot of opportunity there. Same thing going forward today, folks. So with that said, a couple of announcements. Michael said this week, I think they were down to about 67 tickets for the February event. February, I believe it's 17th and 18th, 2024. It's the One Rental at a Time blowout. It's going to be a celebration, 50,000 plus subscribers. It's going to be a live event. All of Michael's experts are going to be there, folks. Tremendous value. If you're interested, my guess is it'll probably sell out in the next week, week and a half. My guess is there's probably about 50 plus or minus tickets left. I would say buy your ticket if you have any interest in going live. You can buy your tickets at onerentalatatime.com. Also, Michael made an announcement. He wanted to hear back from you. If you are not able to travel, of course you want to be there in person, but if you're not able to, he talked about and teased the idea that he may do a virtual ticket as well. So if you're interested in the virtual ticket, please make comments here. Please subscribe, like the video. Thank you for watching. Have a great day.